Good afternoon, everyone, and welcome to the second webinar to our micro-business valuation series. A special hello to our Knowledge Shop members joining us today, and a reminder that you do have access to a range of accounting support services. So if you do find yourself stumped on a valuation query or any query in the tax or super space, then don't hesitate to contact consultants on the Knowledge Shop help desk. If you're not a member but interested in knowing how Knowledge Shop can help you with our help desk, our work bank of papers or our training, then don't hesitate to give Julie a call on the 1-800 number you see there on your screen. Now, last week we looked at valuation methods appropriate for micro businesses, and today we go a little bit further by exploring whether or not we can use business appraisals as an alternative to valuations. Joining me here today to take you through that thought process is Greg Hayes, Director of Hayes Knight, and someone well versed in the valuation space. Now, before I hand you over to Greg, just some housekeeping. Hopefully you can all hear me nice and clearly. If you can, if someone could let me know through the question box, that would be appreciated. If you can hear me, fantastic. Thank you very much, Wayne. Now, the slides were sent early this morning. If you don't have them, don't worry. You can download them and print them out from the handouts area on your grey panel. Thirdly, Greg is more than happy to take questions. So if you do find yourself with a query, then type them into the question box. Greg will either answer them then or there or hold them back towards the end of the session. Now, I know Greg's got a lot to get through, so without further ado, I'll hand you over to Greg.
Thanks very much, Nadine. Hello, everybody. Good to be with you today and picking up on this second part of our series on valuations for micro businesses, and today's a bit different because really we're not talking about valuation. We're talking about a possible alternative to a valuation for your micro business clients, and that's a business appraisal. And what we're going to try and do today is have a look at one, what a business appraisal is, how you would do it, when's it appropriate for you. Certainly we're going to talk about sort of can it be more effective than a valuation, and for some of your micro business clients, certainly the answer in certain cases will be yes. We'll talk about it sort of in terms of the service delivery, how you go about doing that, how to avoid the problems with professional standards, particularly APES 225, and we'll walk you through the key elements of a business appraisal, and I will talk you through a case study in relation to sort of a simple business appraisal. As Nadine mentioned, if you have any questions as we're going along, please send them in because probably best for us to deal with them in the context of the part of the presentation we're talking to at the time. So first of all, just to get a bit of your feedback, if you think about your micro business clients, and particularly those ones who might be either looking to buy a business or looking to sell a business, when they come to you, but particularly if they're looking to buy a business, when a micro business client comes to you sort of with the idea of a business they're looking to buy, what do you think they're really after? Sort of forget about the words they're using, but in terms of what's actually going on, are they after a valuation? Are they really after your opinion on whether or not they should proceed sort of with this business? Do they want to know what the problems are? Or do they want to know if it will stack up for finance? Just based on your experience with your clients in that micro business space who come to you from time to time and say sort of, here's this business, I'm thinking of buying it. What is it that they're really after? Just pop your answers in. Sort of, we'll just give it a few seconds longer, sort of, to get your feedback, and we'll talk about what we're seeing. Just about got most people in. A little bit of time just for those who might be still just thinking about it. What's that client really after when they come and talk to you, irrespective of the words they use? Okay, we might just close it off there. Look, the overwhelming number of you, sort of 86% of you have answered B. They want your opinion on whether or not they should proceed. Sort of, do you think I should buy this business? And look, certainly that's our experience. Sometimes the client might come in and say, here's a business that I'm looking to buy. Here's the financial statements of the business. They may even say, could you do a valuation on it? There will be some cases where they may need a valuation. For instance, if they've applied for finance and part of the conditions of obtaining finance is that they have a valuation on the business, then sort of it's quite clear they'll need a valuation in that situation. And yes, if you're aware or can see any problems in the business, certainly they want to get that feedback. But overwhelmingly, a lot of these clients, a lot of these micro business clients are really looking for your experience and your opinion on whether or not they should proceed. These typically are people who are either they may be relatively inexperienced in business, or they may be experienced in a particular type of business, but perhaps not the one they're looking at buying, or they're not necessarily highly experienced with sort of financial statements, financial information, and all the things they should be looking at. And that's really sort of why they come to you as an advisor, because they're saying sort of, can you steer me through this? Sort of, I'm about to make a major decision, I'm about to make a major commitment. Can you steer me through and sort of help me to know whether or not I should be buying this business? And that's really where this concept of a business appraisal came from. We probably developed this in Hayes Knight. I'm going back here sort of, and this sort of ages me sort of, but I'm going back here probably 20, 25 years ago. We were having clients who were coming to us, and in a number of cases sort of they were coming to us and saying sort of, look, I'm thinking about buying this business, could you do a valuation for me? And oft times, and I'm sure you've all had this experience, when you do a valuation on a micro business, particularly if you're doing valuations using sort of more traditional valuation methods, earnings-based methods, cash-based methods, you will often come up with the outcome that value will be less than price. And so it wasn't uncommon sort of for the client to ask you to do a valuation. You would come in at value being less than price, and the client would go away with that perception sort of, I probably shouldn't buy this business. But that, in many cases, wasn't really what they were after. Really what they were after was a broader opinion from you sort of about whether or not they should proceed to buy the business. So let's keep going and have a look at why sort of a business appraisal might be a better alternative. First of all, what is a business appraisal? It's a micro business advice service, and I really need to stress that it's a micro business advice service. I wouldn't recommend that you try and use this approach with larger businesses. It's something that works well for small business and micro businesses and their owners. It's an assessment of the business from both a financial and a non-financial perspective. So it's broader than just looking at the numbers. You are sort of picking up sort of a lot of non-financial position. It requires you to do a level of qualitative analysis relative to the market that this business is in, and that's where sort of you're doing a broader body of work than you might be doing in a valuation. And it's also making an assessment of the suitability of the buyer to the business. Is your client going to work well in this type of business? Now, that may be a relatively simple question to answer if you have the situation where the client is, it's the motor mechanic who goes and sort of buys a sort of a mechanical workshop. So the person's an experienced motor mechanic, and sort of, yes, they've got these additional issues now having to cover sort of the management, the administration, dealing with the clients and that, but they've got the core competencies of the business. Sometimes you'll find you'll have clients who are looking to buy businesses or are considering buying businesses that are totally outside of their previous experience. One that I think of that happened quite some years ago. We had a client who was he was a serial buyer of businesses. So during his life cycle with us as a client, he bought and sold 5 or 6 businesses, and so he'd buy a business, build it up, sell it, move on to the next business. So he never lasted in a business any more than probably about five years. And sort of had this habit of sort of buying and building businesses, and really that's where his core competency was. His core competency was sort of his ability to build businesses, and he tended to be pretty good at marketing. And in the probably in the early stages. It was probably business number 3. The previous businesses that he had been in were more in the, I mean, they weren't accounting or anything like that, but they were more in that sort of professional services space. So they were businesses that were typically sort of Monday to Friday businesses. They were sort of, they operated from 9 o'clock to 5 o'clock. And yes, he did a bit of work after hours and sort of went and saw some customers after hours and that sort of thing. But it was pretty defined in terms of sort of what work life was. The third business that he bought was a convenience store, and it was a convenience store so it was a small supermarket. It was in a regional area, small supermarket with a liquor license, and this business traded 7 days a week, and typically operated from about 7 in the morning through till around about 10 o'clock in the evening. So it was a 7-day-a-week, long hours that this business operated for. Now, certainly back in those days, the greater proportion of his trading activity occurred in cash. So people would come in, they'd pay for the food they were buying, they'd pay for their alcohol, it was cash-based business. Now, he and his wife took the view that one of them needed to be on premises, so they were a bit nervous about trusting their customers, or sorry, their staff, and that they were generally going out and sort of employing staff who were largely looking after the counter, looking after the cash register and that sort of thing. But they felt that one or the other of them needed to be on premises when they had this sort of, while the business was open, sort of probably just in terms of keeping an eye on the staff and keeping an eye on the cash register. They lasted in the business for 11 months. And the reason they lasted in the business, it had nothing to do with financial performance of the business. The business performed pretty well financially. It made good money. Was it necessarily a hard business to operate in? Not really. Sort of, you needed to understand sort of what the business did, but it wasn't fundamentally a hard business to operate in. They enjoyed dealing with the customers. The thing that just destroyed them was the hours, the sheer hours that this business demanded of them. And that assessment of will this business suit this buyer, I think, is sort of one of the overlays that come with a business appraisal. And if you understand sort of the demands of the business, you understand the client and what the client has been used to, simply sort of telling the client or explaining to the client sort of what is going to be the requirements or talking them through that becomes an important part of it. And ultimately, the client's looking for you to give them an opinion of, yes, I think this stacks up, or no, I don't think it stacks up, or for you to buy this, you need to understand here are the consequences or outcomes of it. So when do you use a business appraisal? When do you use this process? And we're talking about sort of when to use it as an alternative to evaluation, or to discuss it with a client, perhaps as an alternative to evaluation. The first thing is it's only appropriate when you're considering a transaction. Typically, it's a transaction-based service. So you shouldn't use it in dispute or tax-based scenarios. So if there's something that's occurring where there's a restructure occurring and you need a market-based valuation for tax purposes, that has to be a valuation. You can't play around with that because the commissioner is quite clear in terms of what his expectations are. Equally, it shouldn't be used in a dispute-based scenario, because in a dispute-based scenario, again, it's a valuation that if it needs to get into court, it's a valuation that needs to be tendered into court as evidence. So it's more something that you would use on a transaction basis, most commonly when a client is contemplating buying a business, or secondly, it could be a client who's contemplating selling a business, and sometimes you might do the business appraisal as a way of essentially doing an internal review of the business in preparation for a sale. And as I've said before, only appropriate for micro businesses. It won't work. If the business gets larger, it won't work. And we talked about our definition of micro businesses last week. Why a business appraisal rather than a valuation? Sort of why do one rather than the other? we found sort of for the type of client we're talking about, that often the business appraisal is more meaningful to the client. You're actually providing them a better level of information. I mean, at the end of the day with a valuation will only provide them with an opinion of the value of the business, and it's a test to price. So, you know, there's a business that's on sale for $520,000. You do your valuation and you come up with a valuation that says we think this business is worth $410,000. Okay, you've provided the client with a piece of information that says, you know, price is trading at a premium to value, which could be quite normal. But it's not actually giving them sort of a broader assessment of the business, and typically they won't work their way through your valuation report sort of to find out any of those other issues that you may have covered. And so the business appraisal tends to be a more holistic form of assessment. You are sort of covering it in a more holistic way, and your report also is explaining it probably in a way that is more likely to be better understood by a client who is less financially and commercially sophisticated. So it works well in that situation as an alternate to evaluation. Now, another question for your feedback. What do you think is most important to a micro business owner? Are micro businesses, are they more concerned about A, profitability, B, tax liability, C, cash position, D, investment return? And we're not talking here specifically around a valuation issue or a business appraisal issue, but your micro business clients, what do you think they're most concerned about? So their profitability, their tax liability, their cash position, or their investment return? Pop in your answers. Just about there. We'll give it a couple of seconds longer. Just about got everybody's prepared to make a call on this one, so that's good. Okay, let's close it off there. Look, again, overwhelming numbers. 62% have said cash position, 28% have said profitability. Have you ever had that situation or that experience with a client? And again, we're not talking about business valuations or appraisals here. Ever had that experience with a client where you sit down with a client, you go over their end of year accounts with them, and you show them sort of their financial statements and their bottom line, and let's assume sort of that it's showing a profit. You show them that profit on the bottom line, whether it's a set of partnership accounts, whether it's company accounts, trust, whatever it is. You show them that profit on the bottom line. Ever had that client say, "Where is it?" The client who says, "Where is it?" is basically saying to you, I see the number you've come up with from an accounting point of view, and I may not necessarily understand all of that, but what I do understand is I don't feel as though I've got that amount of cash. I don't feel as though I've got that amount of money. And that might be because the money's tied up in working capital, it might be tied up in stock, it might be sort of increasing in debtors, it might have been spent to pay, sort of buy sort of more plant and equipment that the business needs, might have been taken by the owners and sort of charged out to a loan account, sort of whole range of reasons. But often sort of the issue that a micro business is most focused on is their cash position. It's that simple mindset, that simple mentality of I understand money coming in, I understand money going out, I understand what's left in the bank. The rest of it sort of is getting a bit, understand I've got to do it for sort of accounting and tax reasons, but the rest of it sort of I don't fully understand, but I absolutely understand cash position. And again, the business appraisal sort of has a stronger focus towards understanding that cash position. Okay, so the focus of a business appraisal is around cash requirements, cash returns, and time period for cash returns. So what we're trying to do here is we're really trying to simplify this thing down. We're trying to keep it as simple as possible. And And this is part of the reason why I say sort of it's your micro business clients that it's appropriate for. And you may say, Greg, sort of look, there are some clients who we have who operate micro businesses, but who are quite financially sophisticated. If that's the case, then maybe this isn't the right approach for them. You need to make that judgment sort of based on your client. What we have found is that for that more simpler type of client who requires sort of simpler answers and solutions, so the business appraisal sort of often gives them sort of a lot of quite valuable information. So let's have a look at the appraisal process and what it is that you would typically cover in the appraisal process. We'll just go through this pretty quickly, and then we'll have a look at some of the pieces in a little bit more detail. So what a business appraisal would look like, what the process does, and ultimately what your report's going to look like. It's going to identify the history of the business. And then we're going to identify what the client's buying. We're going to do a level of financial analysis. Now, that's going to be historic. We're going to have a look at markets, products, and services. We're going to calculate the break-even point so that the client's got a really clear picture of sort of what level of trading do I need to be at, sort of where I'm at break-even, and understanding sort of, there's a level of sensitivity analysis that comes into that. They should have some understanding, and we should cover sort of competition and competitive position, look at some non-financial indicators, then have some financial projections and sensitivity analysis for them. So the financial analysis we spoke about previously was looking backwards, the financial projections clearly looking forward. Calculating the payback period, talk about that in a moment. Compare price to market, ultimately an opinion on the suitability of the business to the purchasers, and prepare and issue your report. So that's your business appraisal. That's your business appraisal process. In the notes that I think we sent you, I've given you a reasonably simple work paper to do that with, and sort of broken it down into a little bit more detail. That work paper is not meant to be fully comprehensive at all. It's meant to be a work paper that you can use with as your starting point, and then you can sort of adapt, modify sort of as you need it. But it just helps to sort of drill down a little bit more into the detail of the process. Now, let's talk about this for a sec. First of all, the history of the business. What we're looking for in the history of the business is we're looking for a chronology of the major events. How long's the business been around for? And what major events have occurred in the business. Major events could be if there's been change of ownership. Major events could be if there's been change of location. Major events could be sort of that we moved in, we moved from one sort of market to another market, so we made some changes. So, what's a history of the business? Second thing is to understand the maturity and those key changes. That's really what we're trying to do. From the chronology of major events, we're trying to drill down and understand sort of business maturity, and sort of have there been key changes that perhaps sort of explain what may or may not have happened in the financial statements. What is the client buying? The client comes into you and says, sort of, I'm buying sort of this business. Okay, what makes up this business? So what we're then talking about is segmenting the business, segmenting perhaps the purchase price into some asset classes that are being purchased. So are there fixed assets that are being purchased? If they are, what are they? Are there any intangibles that are being purchased separate from the goodwill? We assume there's goodwill coming with it. And is there a working capital? Is there working capital, such as the most common piece obviously is trading stock? So it's about sort of setting out quite clearly sort of for the client sort of what it is that they're buying. Equally, sort of when you're just going back there, when you work out with the client sort of or provide the client with the details of what they're buying, and typically sort of that piece of how much is my investment. One of the things that you should do, and what we would typically do, is we would say sort of, okay, sort of the purchase price is, for example, $250,000. You're buying sort of $50,000 worth of fixed assets. Here's the schedule that goes with that. There aren't any intangibles. Sort of there's another $100,000 worth of stock that comes with the business, and so by default there's $100,000 worth of goodwill. So that's basically sort of the assets. But what other things is the client going to need to fund to run this business? And you just need to think about, I mean, obviously this will vary from business to business, but the sorts of things that sort of often come into it, legal costs in terms of the transaction, stamp duty. They may need to provide a bond for premises. They may need to prepay some rent. Are there any other licenses they need? Are there any other things that they need to do? So part of it is to say, okay, sort of here's the purchase price, but what are the on costs? Because it's that total investment amount that actually is a critical starting point. And again, sort of ask yourself the question, have you ever come across the client who has said, okay, I need $250,000 to buy this business. They scrape up the $250,000 and then all of a sudden these other things come on that were quite natural. They were always going to be there. They were always going to happen, but the client just hadn't thought about it because they just thought about the face price of the business. But if you've identified for them you're going to need these other things, then they start to understand, okay, this is how much capital, and whether it's going to be funded by debt or whether it's they've got the money in the bank or how they do it. But it's about understanding sort of how much cash is going to be required at the front end to make this transaction work. That alone sort of is a fairly valuable piece of information for the clients to have, and sometimes one that's overlooked. Okay, we're going to then do some financial analysis, and that was going to be a review of the financial history of the business. Probably, depending on the nature of the business, probably looking at sort of three years, maybe 4 years. Really, what you're trying to do is you're trying to understand sort of what the financial history and what the trends are. Sort of are we talking here about a growth business? We're talking about a business that's in decline, and typically in that sort of financial analysis, we would look at the revenue line, we'd look at the gross profit line, we'd look at the net profit line, and we'd probably look at key expenses. And depending on what makes up the revenue, we might want to get some sort of trends inside that. And you might want to also do some sort of analysis between sort of fixed and variable cost. So you're trying to get sort of that in very simple terms, you're trying to get an understanding of sort of how the business has performed at a financial level. Markets, products and services, if you're talking about a business that is a single product or a single service, pretty straightforward here. You may not need to put too much time around this, but markets, products and services, you're looking at your market and your product mix. What's our product and service mix, sort of some analysis of revenue and earnings in terms of contribution by key products and services. Is there one product or service that is really the linchpin of this whole thing? You probably at this point sort of markets, products and services, if it's a business that has key customers, then you might want to do some customer sensitivity. Sort of, there's two customers that this business has, and if you don't have those two customers, then you don't have a business. That's the sort of information that a client needs to understand, and again, sort of a level of analysis across the operations of a business produces this information pretty quickly these days. So most of that sort of analysis isn't hard to come by or put together. A break-even point, as I say, first of all, explain the concept of a break-even point to a client. A lot of clients would have heard may have heard you talk about break-even point, or sort of maybe they haven't, but explain the concept of a break-even point. So the level of sales activity that's required to meet all the costs of the business, and calculate the revenue level where break-even occurs. To be able to say to, particularly a client who is not particularly financially sophisticated, to be able to say to a client, in very simple terms, having done the calculation, you need to be turning over, for instance, $12,000 a week to break even. That, for a financially unsophisticated client, that's an incredibly valuable piece of information, because all they will have in their minds, and I've seen businesses that have done this, who they've gone away in their minds and said, I know my break-even figure, and so that sort of gives me it's like sort of a stop sign or a set of traffic lights. If I'm coming in sort of under if it's $12,000 a week, if I'm coming in under $12,000 a week, I know the red lights are on. If I'm coming in at or around $12,000 a week, it's an orange. There's a warning light there. If I'm well over the $12,000 a week, green light. Keep going well. Because in probability, I'm doing okay. Now, obviously, again, depending on the nature of the business, you would talk to your client or explain to your client in reasonably simple terms the concept of not only revenue levels, but the concept of gross profit margins. The client who goes out and says well, I'll discount to make sure I get my turnover up. Obviously, there's movement that's occurring there at margin, which is pushing out their break-even point. But helping clients to understand this break-even concept, if they're financially unsophisticated, is invaluable. Need to do some commentary around level of competition in the market. What other businesses are there that compete? Is it geographic competition? Is it competition from key suppliers? Key players in the market. So what competitive level is there in the market? And depending on the nature of the business, what sort of competition could come on? One of the things that if we were doing a business appraisal, that we might look at, if the business is operating in a space where there's franchise activity, for instance. You might go and look and say, okay, who are the key franchises? Who are the key players that operate in this market? How many of them are already in the local market that my client's in? So it's not just a question of who's there. There's also the question of who's not there, but could enter the market. So understand the competition point and understand your client's competitive position. Where does this business sit in its marketplace? And it might be its local geographic marketplace or whatever, but is it in the top? Is it 1, 2, or 3, or is it somewhere further down? What's its competitive position, and how does it stack up? Because again, if you're in a market that is a hard competition market, one, your clients need to know that they're going into a hard competitive environment, and you also need to make that some level of assessment of, what's my client like from a dealing in a competitive environment. There are some people who can be incredibly good at what they do, whatever that is, but put them under competitive pressure, and they don't stand it. They don't work well in a competitive environment. They are more process-based people. They follow a process to produce an outcome. Put them in a competitive environment, and they don't stack up as well. There are other people who absolutely love competition and really shine in it. But I think part of what the business appraisal does is it helps to understand the client to understand the nature of the environment they're in, and the level of competition that they will or won't be under. And oftentimes, if this is simply explained to people, it will help them make their own decision about whether the business is right for them. Next point that we talked about, non-financial indicators. Identify some relevant non-financial indicators for the business. And these are non-financial indicators that could be easy to measure. An example of a non-financial indicator would be, if it's a retail shop, its number of customers coming into a shop is a non-financial indicator. Number of sales transactions that occur, not by dollar, but by number. So what we're looking at there, and I think about a business that we acted for quite some years ago. It was a fashion business, fashion boutique, and talking to the owner of this business, and this wasn't a case of we weren't doing a business appraisal here for whether or not they were going to buy the business. This lady owned the business and had owned it for some time, reasonably successful, but finding a few challenges, and she asked us to have a look at the business. And one of the things we did was go in and have a look at look for some non-financial indicators, and talking to her about her business, her customers, her conversion rate. When we chatted to her about those things, she was very, very positive that most people who walked into a shop bought something, and that she had a high conversion rate. And so her feeling was that what actually sort of caused her to come and talk to us was she was considering sort of embarking on a fairly large marketing program. So an external firm or external business had put a proposal to her for running a marketing campaign for her business, and I think at the time it was going to cost her about $80,000 to run this marketing campaign. So she was in a regional town, and it was really a question of, Greg, do you think I should spend this $80,000 on the marketing campaign? And we were probably somewhat apprehensive about sort of whether she was going to get value for that. And we said, look, sort of before you make the call on it, sort of let's sort of try and understand your business a little bit better. So in discussions with her, she was telling us about the business, the performance of the business. As I say, sort of expected, she had a pretty high conversion rate. So in her mind, the value proposition, what she needed more customers walking through her store. Because she said, if I've got more customers coming through the store, that's what will cause me to be able to grow the business. And we said, okay, well, look, let's just put that to the test. And what we did we ran this exercise initially sort of just simply for a month. What we did was we sort of basically had her sort of put a counter on her door that counted sort of foot traffic sort of people coming through the door. And so all of a sudden she had a measure of sort of the number of people walking in. And yes, look, some of those people weren't walking in as customers. You know, it might have been sort of a supplier coming in. It might have been somebody coming in sort of to drop her in a cup of coffee, or sort of a friend or whatever. You can allow for that stuff. Sort of you don't get hung up on sort of that type of thing. But what we had is we had a counter of foot traffic. And based on that counter of foot traffic, we were then able to measure from the number of sales she made each day, and she measured this each day for a 1 month period. So at the beginning of the discussion with her, we had said to her, sort of, what do you think is your conversion rate? And after we'd sort of moderated her slightly from believing that she sold to everybody, she was firm in her view that her conversion rate was better than 85%. When we measured it and we didn't believe that for one moment. There is almost no woman's fashion boutique that has an 85% conversion rate. It's unheard of. But anyway, sort of we sort of accepted sort of what she said. We measured the foot traffic coming into the place for a month. We measured the number of sales that were occurring sort of each day. And at the end of the month, sort of we calculated her conversion rate, which was 27%. And she was horrified. And part of what she put it down to was that she believed that she probably sold to most of the customers, but maybe her other staff didn't. Sort of maybe her other staff sort of weren't having the same level of conversion sort of as others, or she was achieving. We then also measured sort of what was her average sale that she made. So all of a sudden, we had the dollars coming in sort of each day, each week. We had the number of sales transactions that were occurring, so we could get an average sale value. So within a really quick space of time, we were able to say to her, Leslie, this is how many people are coming into your store on average. And not only this is how many people are coming in onto your store on average, this is how many people are coming in on average at certain points in the week, which might sort of go towards, do you have enough staffing sort of at sort of your busier times or your quieter times. We were able to measure traffic, we were able to measure conversion rate, we were able to measure average sale. Now, this was a lady who was, she was a smart business owner. She knew her business, but in terms of getting that next layer down and measuring a few other things, sort of she'd never thought about this, and it was just a revelation to her, because all of a sudden she realised that instead of spending $80,000 on bringing more people in to get, if it was successful, and there was an if there, rather than spend $80,000 to bring in more people, if it was successful, to continue getting a 27% conversion rate, she'd be better off to sort of put some money into perhaps the training of some of her staff around sort of their sales techniques, and sort of to do some work around sort of displays in-store displays, and positioning of product near cash registers for other sort of impulse buyers, and sort of working through a program with her like that. she ended up sort of taking a conversion rate sort of over about sort of a 4 or 5 month period. She took a conversion rate from 27% up to 44%, which is quite high for a boutique. She was able to increase her average sale value by around about sort of $30. And so the effect that had on her gross profit and her net position was significantly better than sort of spending some money. So by starting to understand non-financial indicators about a business and giving sort of giving a business owner a few simple things to look at, can be highly valuable. Sort of another client, and so look, these are just examples. Another client in the building industry. This was a domestic builder. And for those of you who've got clients in the building industry, so you may have the experience where some years they have a great year and other years they have lesser years. What we were able to work with one of our clients in the building industry was, again, in terms of what are the things that are important around sort of your business, because these guys, they were good quality builders. They typically built properties that were, it was sort of pretty much a package sort of deal for the property in terms of pricing and that sort of thing. The stuff was well priced. The thing that made the difference to their business was the turnover. How quickly we found for this particular client that if they could complete construction, in 13 to 14 weeks from time of starting construction, that was their optimal time for profit. And every week that it went beyond sort of 13, 14 weeks, there was a certain amount of leakage from their profit. So the whole thing for them in terms of managing their business was how many jobs did they have on the go at any one time, and we'd worked out what the optimal number was for them to have on the go at any one time. And then the second measure was, can we get the jobs done in this 13, 14 week cycle? And if they could have the right number of jobs sort of on the books at any one time, doing it sort of within that 13, 14 week cycle, what actually happened was their profitability sort of was significantly higher than otherwise would be the case. And again, understanding that sort of from the business owner's point of view, they didn't have to go back and say, let me measure my financial statements, let me sort of look at my monthly accounts. And it's not to say that stuff's not important, but in terms of what they could have an influence over, they could have an influence over the operational side of the business. And that's where you're looking for non-financial indicators. And every business, doesn't matter what it is, every business has non-financial indicators. So, part of the process in the business appraisal process is to identify some relevant non-financial indicators for the type of business that your client's looking at, and then the ones that are relatively easy to measure, and then give those to your clients so that they can, it's just a management tool sort of help them to operate their business with. Hopefully, and I'm sure for those of you who are principals or partners in your firm, you would be using non-financial indicators to measure sort of your own performance in your accounting firm. Financial projections. Financial projections, we obviously need to do some projections sort of the forward position of the business for the next year, and then do a little bit of sensitivity analysis around those, so as to sort of see what occurs if we sort of if the business underperforms projections or overperforms projections. Next piece is payback period. Most business owners understand payback period. If you calculate the payback period for the investment, so if you say to the client, you're going to be spending $250,000 to invest in this business, this is the sort of return this business is making, it's going to take you, it's going to take you 3 years to get your money back, it's going to take you 5 years to get your money back, it's going to take you 10 years to get your money back. People generally understand the concept of payback period, and clearly, again, in terms of explaining it to the client, within reason, the shorter the payback period, typically the better the quality the investment is going to be for them. But the issue for them is to understand what payback period is, and certainly if you get a payback period that is running longer than 5 years, that generally sort of is a negative indicator sort of about the business, particularly sort of micro-based businesses, you would hopefully get a payback period sort of inside 3 years. Price to market. What we're talking about here, and this is the difference to a valuation, rather than coming up with a valuation and saying the business is worth this amount by comparison to the asking price, what you're doing here is comparing the price on the business with available market information. So are there other businesses of this type for sale? And if there are other businesses of this type for sale, or if there are other transactions that have occurred, how does this compare with the market? Now, for some businesses, quite hard to do, because some businesses, if they're quite unique, there may not just be sort of market information around, but other businesses, there is that sort of information around. And if there is sort of, then, it's a helpful piece of information for a client to understand how does the price being asked on the business compare to market. Final steps, you're going to give coming out of all of that, you're going to provide an opinion, and your opinion, your opinion could be sort of don't touch this business sort of with a barge pole. Sort of could be sort of this business looks attractive. Oftentimes your opinion will end up being a qualified opinion, which is saying sort of, look, if you can sort of manage to achieve these things, then sort of it should stack up well. If you've got doubts about your ability to achieve these things, then sort of it may not turn out to be as good an investment as you might otherwise want. And then ultimately, sort of you would provide this to them in your in a simple report. As I said earlier on, as part of forming your opinion, and apart from the financial issues and the business issues that you are going to look at, you would also expect that you're going to consider this issue of suitability of the business to the purchaser. What is it going to require of the owners? And this is particularly valuable, as I say, for either people who are first time in business, or alternately people who are first time in this type of business. So what are the requirements in terms of ownership working in the business? What are the hours that are involved? Sort of, what's the demand? Sort of in terms of, physical demand, sort of stress. Are they going to have to do after hours work because the business sort of dictates that they've got to go out and do quotations or the like, and maybe they've got to do those after hours if they're dealing with domestic customers, or does it require weekend work? Does it require a lot of travel, or is it sort of more centrally located? It's about sort of identifying what the requirements are. You might form a judgment then, particularly if you know the clients well, you'll probably form a judgment on how the clients would cope with that. But even if you're not able to form that judgment because you don't know the clients well enough, simply saying sort of here's the likely requirements that are going to come with this business on you as the owner, helps the client sort of to make some assessment of whether it does suit them. In terms of your work program that you will run, your data collection without question has similarities to evaluation. So if you have a look at some of the data we're suggesting that you would need to collect, or you would need to look at, data collection has a lot of similarities with valuation. It's just that you're going to be using it for a different purpose. Your analysis and focus is much more based on the business and its sustainability and growth. So you will need to do a bit of broader research with that. Value is generally not a consideration. You're not expressing an opinion on the value of the business under a business appraisal. You're providing much more sort of factual. So, your payback period, so that's not an expression of what value is. It's simply saying this is how long it will take you to recoup the capital that you're going to outlay. It's more about sort of that suitability of the business to the purchaser. We looked at trying to go through a case study with you, and there's a case study that in my book, and for those of you who've got the book and the latest edition, which is from a couple of years ago. So it's not something that you would need to have bought sort of the book more recently. But there's a section in my book, my valuations book, if you have that. If you don't worry, sort of, because we're going to deal with this. There's a section on business appraisals, and I've given sort of an example of a business appraisal report. If you've got the latest edition of the book, it's on page 259, and it sort of goes for about 10, 12 pages. What we're going to do, and the case study that you can see in front of you is the case study that came out of the book, and where we not only sort of provide sort of the background to the business, but we actually provide sort of a sample of what a business appraisal might look like, and sort of the process that you might go through with that business appraisal. What we're going to do is Nadine will sort of after the program is finished today, Nadine will send you out a copy of this so that you can just sit down and read it at your own leisure. There is no look, in terms of business appraisal reports, there is no sort of exact format that you have to use with this. It's not governed. It's not perhaps quite the same as a valuation where there might be some more expected formats. It certainly doesn't have the strength of a set of financial statements or the like. So you've got some flexibility around that. But if you see what we provide you with, the example that's worked through, it'll give you a bit of a sense of what we think you might cover. Somebody asked, what's the typical fee for a business appraisal for the example provided? Look, I would think, for a business appraiser generally will be sort of somewhere in that, probably that $2,500 to $5,000 range. In terms of doing the job, if it depends a little bit on the complexity of the business and how much work's got to be undertaken. So, the fees probably for a business appraisal are going to be less than a valuation, because you, at the end of the day, you're not signing off a value opinion. Whilst you are sort of perhaps expressing an opinion on the client of the suitability of the business to them, you're not signing off on that. So business appraisal will typically sort of a bit less, but again, the advantage of having standardised format of how you do this type of work, if you're doing it on a regular basis, standardised format will make life so much easier for you. But in this case study we had a look at, a little country supermarket, small country town, could be a small country town anywhere, and a small supermarket that was up for sale for $170,000. So it doesn't sound sort of like a huge investment, but it's only sort of a reasonably small business. We'd calculated there was another $60,000 that need to be allowed for in entry costs and $15,000 in working capital. Again, when you see the story, you'll see the full point. So the client was looking at spending $245,000. Now, when you then look at the business was turning over around about sort of $1 million and appeared to be pretty consistent around that $1 million. Had a gross profit margin of 19.9% and a net profit level of 7.1%. Traded Monday to Friday and sort of part of Saturday. In terms of the benchmark analysis of the business, again, you'll see this when you read through it. In most areas, the business was within the benchmark range, but trading at the lower end of the benchmark range. And so the performance opportunities there were sort of for this type of business was in terms of looking at the product mix, and by product mix, typical of these sorts of businesses, small supermarkets. Why are people using them? Are they going there sort of to buy their bread and milk, or are they going there sort of to buy sort of a broader range of products? Margin on bread and milk sort of quite low, whereas it's the broader range of products, and so it's possible. And again, sort of looking at sort of some of the benchmarking information that was available for this business, what it actually showed was that sort of when revenue levels got down sort of sub $1 million or sub $1 million, gross profit margin sort of dropped down to sort of typically around that 18 to 22% range. But when revenue went up over sort of $1.5 to $2 million, gross profit tended to go with it. And what that was a clear reflection of for this type of business was that when the customers start spending on the broader product range with the higher margin on it, the higher margins on it, then sort of your margin gets to lift. And so there's no question. So one of the issues for this business was in terms of what the spend was in terms of the product mix. There was too much money going into the basics and not enough going into what was sort of the product range that had sort of better margin on it. Clearly, the operating hours in terms of sort of would it help the business if the hours were extended somewhat? Now that sort of obviously is also an issue for the owners, not only in terms of cost but in terms of their own commitment. Pricing was an issue in terms of do we have sort of our product priced the right way, and the number of stock turns. So there were some very sort of obvious things that showed up in this business. But as I say, sort of we're going to send you out the case study and let you have a good read through it. Don't read it on the basis of this is exactly the way I've got to do it, this is the way I've got to copy it here. This is simply an example of the sort of information analysis that would go into a business appraisal. And if you think about it, as you're reading it, think about it from the point of view of your client. Would this information be helpful for my client in terms of assessing whether or not we should invest in this type of business? For what it was worth, the analysis we came out with and this I think was an example of a business appraisal we did sort of some years ago. The analysis we came out on was that sort of this business was marginal. It was arguably overpriced. But it was irrespective of price. The reality was sort of it was a marginal business, and the only way that sort of it stacked up from an ownership point of view is if the owner was reasonably confident that they could grow both the revenue and the margin. And we'd given them some sensitivity analysis that told them sort of what that would look like, what the payback would look like if they could increase that sort of revenue and margin. And and it didn't actually take that much. You increase the revenue and the margin by around about sort of 25%. And this business went from being sort of not particularly attractive marginal business to sort of a business that for its investment sort of was okay. But from a client point of view, sort of a really sort of valuable piece of information for them to have. What we'd expect to see in a report is sort of firstly sort of that explanation of what the investment is, what we're investing in. Hold on, we're getting away from ourselves here. So what we're investing in, as I say, some explanation about the business and financial performance, the financial analysis, the major expense areas and the projections, payback period, return expectations, break-even point. We'll talk about some of these things in a little bit more detail as we go along. Some of them we've already spoken about. The report also gives you the opportunity to pick up other issues relating to the business and which will vary. Again, I'll sort of talk to you about those. Financing, sort of if they're going to have to finance the business, sort of how they would perhaps look at that, and then sort of the issues around sort of the legal side and ultimately your opinion. Just in terms of return expectations, we again with a business appraisal, we would typically sort of break it down and say, are you going to work in the business? If you're going to work in the business, how much do you expect to, what's fair return for working in the business? How much capital you are going to invest? What rate of return could you get if you invested that capital, in a bank, sort of in a less risky environment? And then what sort of risk premium would you expect to get? So part of what our business appraisal process does is gets into the client's mind, sort of rather than if I buy this business, this is how much I will end up taking out of it. How much should you reasonably expect to get paid to work in the business? And if that working in the business is I'm going to be sort of stacking shelves and managing a cash register, okay, so what you get paid for stacking shelves and managing a cash register isn't all that high, but sort of you should be paid for that. How much capital are you going to invest? What would you get if you sort of invested that in the bank otherwise? And then what's the risk premium that you should take out? Because when you break it down and get the totality of return, then the client's got a basis of saying sort of, okay, this is what I should be getting out of the business. This is what it looks like the business will produce. Other issues that you might cover. And look, this is by no means sort of a comprehensive list, but things that might get picked up in sort of this other issues area. Physical requirements on the owners. We've talked about that. The competitive position and the level of competition that's going on. Is the business what business has got a customer focus? Now, you might have some clients who, I'm sure you've got clients who actually don't like other people. And I don't say that sort of, I don't say that flippantly, but some people are very sales focused. They're they're very much people person, people. But so there are other people who sort of, they like to get on and do the job, but they're not sort of, they're not the best person to engage sort of with the customer. So what level of customer focus is required? So what's going to be required on these owners? Understand the environment and the market of the business. Does the business have, as an example, does this business have location goodwill? And if it's got location goodwill, is there anything that's happening in the area? Encouraging sort of the potential, your clients to go out and have a talk to some of the business owners in the area and just get a bit of a sense of what's happening in the area. Sort of, is there any sort of market information that sort of is relevant to them? If they're buying sort of plant and equipment, they need to satisfy themselves as to the condition of the plant. Now, they may be able to do that themselves, depending on what the nature of the business is. They may need to get somebody to come in and have a look at it. But the last thing you want is to buy a business and, a month later sort of find that sort of major parts of your plant have broken down or sort of given up and you've got to go and replace those again. So at least understand what you're buying, and also sort of obviously the quality of the trading stock, sort of letting people know that just because the stock, people have got stock take sheets that says stock is worth X number of dollars. What's the age of the stock? What's the turnover like on different sort of stocks? So is there stock there that's obsolete? Is there stock there that sort of might be damaged? Sort of, does there need to be any sort of adjustment to pricing sort of because of the quality of the trading stock? These are all relatively simple things, but again, for an unsophisticated purchaser or people who sort of don't find themselves in this space too often, things that are sort of worthwhile and can be incredibly valuable for them. Okay, so how do you do all this and not fall foul of APES 225? And I think you will appreciate that APES 225 is the valuation standard and professional standard on all members of accounting bodies who provide valuation opinions or provide any opinion on value. So if you provide an opinion on value, you will be caught by APES 225 in terms of procedures you need to do and requirements, some of which are totally irrelevant sort of in a business appraisal. Now, I've said there a business appraisal should not be caught by the standard. If you do a business appraisal as it's intended to be done, then you will not be caught by the standard. However, much of it comes down to the language you use in your report. And it doesn't matter that you call it a business appraisal. Sort of APES 225 is very, very clear. This has nothing to do with whether you call it a valuation or not. You can call something a business appraisal, but if you start to drift back into the language of talking about value and expressing opinion on value, then you are probably taking yourself into the path of the standard. So you need to ensure your language stays away from that. If you are making statements on the relativity of price to market, that is not a commentary on value. So if you were saying, so this business is for sale for $240,000, and sort of a recent survey or sort of a recent review of the market suggests that businesses of this type are currently selling sort of between $180,000 and $300,000, that's not an opinion of value. All you're making is a statement of price relative to market. So again, providing you're not making that sort of that view about statements about value, sort of, then you shouldn't be caught by APES 225. In your report, your focus is on the business. It's a focus on the return on investment. That's where you're talking about payback period or otherwise. Your opinion on the attractiveness or otherwise of the business, so there might be risks associated with the business. Again, the mere fact that you talk about risk doesn't take you into the valuation space. Bear in mind, of course, that whilst H225 sort of may not apply, some of the other professional standards will be relevant in terms of sort of engagement terms and providing opinions to clients on different aspects. So you might be okay on H225, but so there are other standards sort of to be mindful of. So why do business appraisals work? In conclusion, why do business appraisals work? They are a simple advice format. Again, I just stress they're for micro business clients, and they're probably for clients who are slightly less sophisticated in terms of their business understanding and their financial understanding. They tend to be heavily cash focused, so that they're looking at sort of that cash flow movement that's coming in and out of the business, and they will link performance issues to financial issues. So when you're sort of looking at some of those non-financial indicators, you will have that ability to link the financial to the non-financial. Typically, a business appraisal will identify improvement opportunities. So they'll, if you can say this business sort of is operating at a gross profit margin of, in this case 19%, however the average for the market is 23% or 24%, then you can start to show sort of what the differential would be if they can start to improve that and identify areas where that improvement might come from. And it does provide some level of rationale for the client's investment. As I say, we've used these. We don't use them. We only use them sort of where it's a micro business. So we're not using them every day, but sort of in the right situation, sort of they are an effective tool. And sometimes that client particularly that micro business client who walks into your office and says, "I'm thinking about buying this business. Could you do a valuation for me?" Sometimes by having that conversation with them and saying, what is it you're trying to find out about this? What are you expecting from the valuation? A bit of a discussion with the client will sometimes demonstrate to you that really what they need is not necessarily a valuation. It's more a broader opinion and view of the business. Hopefully, sort of what we've covered there sort of will assist you in thinking about sort of business appraisal work and the use of that. As I say, sort of Nadine will send out to you, for those of you who don't have a copy of my book on valuations, Nadine will send out to you a copy of the case study sort of that is in the book. If you've got the book, you don't need to wait for Nadine to send that out. Just go to page 259 and have a read of the next 10 or 12 pages, and that will give you a copy of, or that will give you a report summary sort of on a business appraisal. Hopefully, sort of doing that sort of will certainly assist in getting that. Now, somebody's asked the question, is it possible to obtain a copy of an example appraisal report? Look, if you have a look at the book, I mean, essentially what's in the book is an example. It's not set out sort of as a client advice piece, but if you followed that example that's in the book of what the report looks like and just follow the sequencing that I've given you, that's exactly sort of what a report would look like. I mean, clearly the content of the report will vary from business to business, but that will give you, I think, what you're after. Thanks very much, everybody. Sort of let me hand you back to Nadine.
Thank you very much, Greg, for taking us through those considerations when looking at using business appraisals. As Greg mentioned, I will be sending through that case study as well as a copy of this webinar recording. So do look out for it this afternoon. Now, if you want more training, then you're in luck. Knowledge Shop, we've got a range of webinars and full-day training programs coming up. You'll see the range of topics we've got up there. So do keep looking at our Knowledge Shop training website as we release the topics. But for Greg and I, thanks very much for your time today. And we look forward to seeing you next time. Thank you.